In Money Watch, stocks rebounded in midweek trading. The Dow Jones recovered most of yesterday's losses, ending the day up close to 600 points.
The S&P 500 and NASDAQ also had strong days as investors shrugged off the Ukraine and Russia conflict. Both were up more than 1.5%.
We want to bring in Jeffrey Kleintop now. He's a chief investment strategist for Charles Schwab. Jeffrey, welcome. Thanks for being with us. So all major indexes saw gains today. What drove up the market, almost 600 points today?
Well, a couple things. You maybe had some further developments on the ground in Ukraine that were maybe better than expected in terms of a stalled column of advancing Russian troops and just more potential opportunities for diplomacy. But even more importantly, perhaps energy prices had been receding earlier in the day. Energy is a big driver of where the market goes from here, given the concerns about inflation and economic growth. And as those prices came down, stocks rebounded. Yet in the afternoon, as those prices came back up again, those gains began to fade, or not fade, but they began to moderate a little bit, and the market ended up flattening out.
Short time ago, we heard from the Secretary of State, who announced that there will be sanctions on the Russian defense industry. We've got a whole scope of sanctions on Russia. Will we see a further impact on the markets?
Well, in terms of the sanctions, I think the real impact sanctions seem to be having is the ones that are voluntary, actually. The companies that are saying we're not going to do business with Russia anymore, whether that's on the oil business side. We're seeing a number of major oil companies divest of their Russian assets and Russian operations. We're hearing many other companies stop selling products into Russia, and that is far more impactful in terms of potential revenue impact for businesses, but also certainly with regard to Russia, than maybe these sanctions that seem to be avoiding energy and agriculture, Russia's two biggest exports.
And Jeffrey, of course, this is such a fluid situation between Ukraine and Russia. Nobody knows exactly how it's going to pan out, but there are some defense experts warning that this conflict could last years. So obviously right now there is this volatility with the stock market that's reflecting what's going on over there and the sanctions and all the general uncertainty. Can the U.S. economy learn to live with this conflict if it drags on, without reacting in such a volatile way every day?
Well, unfortunately, we have 40 years of geopolitical developments and certainly more than a decade of Russian aggression in Crimea and Georgia, suggesting this hasn't ended. It just flares up from time to time. And as a result of that, markets have reacted during those periods where there was conflict, but then quickly rebounded as the conflict began to moderate a little bit. We saw this back in August of 2008 with Russia's invasion of Georgia and ultimately the independence of South Ossetia and Abkhazia. We saw the same thing in 2014 when Russia had invaded Crimea. Markets flare up from time to time. We get a period of volatility, though not necessarily markets moving only to the downside. They back up on days like today. But ultimately, if we can see that energy prices remain relatively contained, we don't see spikes up to $150 or $200 a barrel, then I think the economic damage and earnings damage may be limited, allowing markets to recoup their gains.
All right. Well, Jeffrey Kleintop, chief investment strategist for Charles Schwab, thanks for joining us. We appreciate your insight.
Thanks for having me.